You ever hear about a surefire way to make money and immediately think, yeah, I could do that too? Maybe it's a friend's hot stock tip, a viral crypto hack, or even some investment trick online. And if you're like most people, you probably tried it. And yes, some of them blow up spectacularly. Here's the thing. Financial experiments aren't just about numbers. They're about human behavior. Some succeed, some fail so badly they make headlines or ruin lives. Today we're diving into the financial experiments that failed spectacularly. And along the way, we'll meet our example investor, Tom Invest, who learned some lessons the hard way. My name is Nick, and I spend way too much time thinking about financial experiments and economic systems that go wrong. If you're someone who has ever wondered why smart people keep losing money to foolproof schemes, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Let's start with one of the most famous disasters in history, Tulip Mania in 1630s Netherlands. Tom Invest might have thought, I love flowers, I'll invest in tulips. But here's what happened. Rare tulip bulbs sold for more than 10 times the annual salary of a skilled worker. Imagine paying $500,000 for a single flower bulb if your salary is $50,000. Here's what most people don't realize. The buyers weren't buying tulips because they loved them. They bought them because everyone else was buying them. The herd mentality drove prices sky high. Fast forward to England, 1720, and we have the South Sea bubble. Tom Invest reads about a company promising huge profits from South America trade. Stock prices jumped from £100 to £1,000 per share in just months. Let's break the math. A £100 investment could turn into £1,000. Sounds amazing, right? But the company's real profits couldn't justify those numbers. Tom Invest, like many others, fell for it because seeing neighbors get rich convinced him it was safe. When the bubble burst, investors lost millions. Here's the psychology. FOMO, overconfidence, and herd behavior all combined to make people ignore basic math. Now, Tom Invest tries to learn from history and moved to the US in the 1970s to trade corn futures. The government designed a system to stabilize corn prices, but it was overly complex. Only a handful of speculators truly understood it, and when prices spiked, ordinary farmers lost everything. Tom learned the hard way. Complex systems fail if participants don't fully understand them. The total losses exceeded $1 billion, all from a well-intentioned financial experiment. Here's what gets interesting. Even safe systems fail if they ignore psychology. Take negative interest rates in Europe and Japan. Central banks hoped people would spend more, but they hoarded cash instead. Logic said, spend now, but humans acted differently under perceived risk. Tom Invest saw this firsthand, realizing math alone doesn't guarantee success. Tom Invest also read about Japan in the 1990s, where banks tried fake money stock simulations. Customers practice investing with pretend currency. Sounds safe, right? Here's the kicker. When they invested real money later, many still lost it all. Why? Humans react to fake risk differently than real risk. Our brains just don't take simulations seriously enough. And now the modern mind bender. The US mint $1 trillion coin proposal in 2013. Tom Invest chuckled when he read about it. The idea meant a platinum coin worth $1 trillion to bypass debt limits. Legal on paper, catastrophic in practice if misused. Here's the takeaway. Financial experiments can be wild, creative, and dangerous, even for governments. Now let's make this personal. Tom Invest decides to try something simple in 2008, investing in collateralized debt obligations, CDOs. Simplifying the math, average mortgage is $200,000. CDO bundle, 1,000 mortgages, $200 million. Ratings claimed low risk, AAA. Investors poured billions in. Tom saw the numbers and thought, safe. But many mortgages were subprime. When defaults rose, the CDOs collapsed. Billions were lost. Millions of lives were affected. Tom realized, Understanding systems without understanding human behavior is dangerous. Here's what most people don't realize. These failures aren't just historical, they're timeless patterns. Hype versus reality. People chase quick gains without fundamentals. Herd behavior. Copying others blindly leads to disaster. Complexity trap. Overly complicated systems fail. Ignoring risk. Short-term excitement hides long-term danger. Psychological biases. FOMO, overconfidence, and loss aversion persist. Tom and Vess learned these lessons the hard way, but you don't have to. Here's a practical framework you can apply immediately. Check the math. Always quantify risk versus reward. Ask, if this fails, how much do I lose? Understand psychology. Recognize when FOMO or pressure drives your choices. Start small. Test with low stakes first. Don't go all in on unproven ideas. Simplify complexity. If you can't explain it in simple terms, don't invest. Study history. Tulips, South Sea bubble, corn futures, CDOs. Patterns repeat. Here's a final story. Tom and Vess reads about meme stocks in 2021. People were buying shares of companies like GameStop purely because internet hype said so. Tom decides to try $500. Price jumps to $2,000, then crashes. Why? Social proof and overconfidence again. He saw firsthand how psychology overwrites math, no matter how prepared you think you are. Here's the key takeaway. Financial experiments fail when math ignores human behavior. The systems themselves aren't inherently bad, it's how we react. Tom and Vess now approaches every investment with math plus psychology, asking, what's the actual risk? Am I being influenced by hype? Has this failed before? Following this simple framework allows Tom to experiment safely without risking his financial future. Before we wrap up, here's a checklist you can apply today. 1. Always calculate maximum loss versus potential gain. 2. Recognize behavioral biases like FOMO and overconfidence. 3. Start with small-scale experiments. 4. Question complexity. If you can't explain it simply, don't invest. 5. Learn from history. Failures repeat every generation. So here's my challenge to you. Next time you're tempted by a brilliant financial experiment, pause. Ask yourself the same questions Tom and Vess learned to ask. If you do that consistently, you avoid disasters, learn faster, and build wealth smartly. Financial experiments will always happen. Some succeed spectacularly, some fail spectacularly. Your job isn't to avoid all risk, it's to understand it, manage it, and act with math and psychology on your side. If this video helped, hit the subscribe button, give it a thumbs up, and comment below which financial experiment blew your mind the most. Remember, money's as much about understanding people as it is about numbers. Take control, think critically, and don't repeat the same mistakes.